It is my belief that things don't just happen by chance, but by proper planning. Do you have a retirement plan or simply have an investment portfolio that can use some fresh ideas? Hi, my name is Mike Ecker, and my podcast is called Investment Choices. In my podcast, I will be speaking with professionals who will be discussing alternative investment ideas that may be a good fit for your financial plans. There is more to investing than just stocks, bonds, and mutual funds. Hi, everybody. This is Mike Ecker. This is my podcast, Investment Choices, other than stocks, bonds, and mutual funds. And we deal with different alternative investment ideas. And I'm blessed to have with us today Jason Kjellson. He's worked in the securities and financial industry for over 20 years in the United States and Canada. He has extensive experience covering management, modeling, and analysis in a field that I feel is really a topic today with going on with the COVID-19. And again, I want to start by saying I hope everybody is safe. Hopefully that you're in the house and you got your mask on, unless you're in one of those states where everything is going wild. Everybody be careful and safe. Jason, I want to thank you for coming on board. Again, we're talking generically. I talk about alternative investments in different areas. The area that I'd like to talk today about is the student housing. And if you can give us a brief history of that asset class, I would appreciate it.
Yeah, thanks for having me. I'll echo your sentiment that I hope everybody's happy and healthy right now at home with their families, and certainly challenging times, but hopefully everybody's is healthy. Student housing is an asset class that obviously has been around as long as there's been universities. So we're going back into the early 1800s and 1700s, and I think most people get it. Most people either attended college or their kids attended college, and so they sort of get intrinsically what student housing is. When you get into the intricacies of it and the asset classes and investment is where you start to have to educate folks. But as an investment asset class, it's not nearly as old as the university systems themselves. It's only been an asset class that investors have been interested in for maybe the last 15 or 16 years. And so it really is that word I love to use is nascent as an asset class, and really interesting once you dig into the fundamentals.
And basically, I don't want people to be confused. We're not talking about housing on campus. That's different than the student housing here. This is usually off campus, right, Jason?
That's correct. Yes. So, your typical university is land constrained, and the highest and best use of the land on campus is usually not dorms and housing. It's the academic facilities, which include everything from administrative offices to, these days, some of the most world-renowned medical facilities. And so, where most kids live these days is not on campus. Most kids live in off-campus housing. You're right.
Is it housing where they actually have their own places, or is it housing where there's more than one person in a room? Is it a studio? How is the housing done basically off campus?
That's a great question. Most of your listeners or watchers on the podcast will recognize your sort of typical student housing is sort of a garden apartment. In most schools and universities, it looks just like any other market rate apartment complex. It's just really close to campus. And it depends, to directly address your question, it depends on the property. There really is a big difference between a property that it features one person in a room versus two people per door, so to speak. So then you get from having, a door with one person to a door with two or three people to a door with two people and what we call bed to bath parity, where you have two people per bathroom or one person per bathroom. So maybe you have two people in the room, but you have two bathrooms. And so really right now, when we talk about where we are today, it's those properties that have what we refer to as bed to bath parity that are really shining, because there is a premium on personal space right now.
So, common sense, if you're getting your own apartment, you're the only one there, it's more expensive. If you have 2 beds, it's less expensive. If you have 3 roommates, it's less expensive. So there's different alternatives in each housing sector. Is that correct?
It is. But for your operators, what makes student housing a really interesting asset class is the ability to have numerous beds per key, because now you're talking about obviously numerous economic renters, whereas if you just had one person or one family living in behind that key, you have one economic renter. So it really allows you to diversify your economic renter base.
Well, today's student housing on campus is pretty well booked up, so you have to look at other areas for housing near the college, and that's why I happen to like this class. Normally, we would talk about how the student housing is a recession-proof nature of this asset. Kind of today, nothing's recession-proof. Everything is subject to this virus, unbelievable virus. But tell us a little about how it is recession-proof in a different kind of in a different situation, not today's situation.
Well, that's a really great question, and that really is what has drawn the big institutional investors to the asset class. If you look historically back in time, just at employment, just look specifically. Don't look at any specific university or anything of that nature. The Wall Street Journal has been doing a ton of reporting on this subject over the course of the last 7 weeks as it relates to the current health situation. But if you strip out COVID and look just at the value of a college education to what it means to unemployment, and this gets to your recession-proof question. The Wall Street Journal about 4 weeks ago ran an article that had a really compelling chart, which charted the unemployment rate over time in a line going back to, I think, in the early 90s, around 1992. So you got really 3 recessions, including the one that most think we're about to enter right now. And what was really compelling about that is you had one line, which was those with college educations, one line that had some college education. Then you had the line that was high school educated unemployment rates, and then you had the non-high school educated unemployment rates over time. And to look at the difference, obviously the lowest line, the lowest unemployment rate, whether you're in a recession or not, is those with the college degree. And even what was really interesting about this is even during the recessions during that time frame, the college educated cohort unemployment rate never veered very far from statistical full employment, which is typically around 4%, is what economists sort of look at. And so that was really compelling. It never got above 5%, while the lowest educated cohort had gone up into the 15, 16, 17% range. And so as we get into the potential recession today, or going back to the currency crisis in 2008, and even back earlier than that, really what drives kids to college campuses and then ultimately drives the asset class is the value of earnings over time, the ability to find a job regardless of what's going on in the economy. And honestly, that hasn't changed much over the years.
Okay. I guess one of the things that probably is on the mind of everybody, including myself, is how are the schools addressing the current pandemic?
That's a great question. It's every day there's new developments. And so I've actually gone to one of the things that I've done is that Google, the search engine, has this really cool feature where you can create an alert, and every day it sends you news on whatever it is that you've typed in. So every day you get an update. And so I do that for all of the universities that I'm interested in, just to see what's kind of going on in the world. And every day there's more news. Notre Dame came out recently and said that they're going to have college football, a full college football season. So how are they going to do this? How are schools that are now coming out and saying they're opening going to open? And the way they're addressing it is by saying, look, we're going to test. I think you're going to see a lot of testing. Obviously, most, if not all schools, I think you're pretty safe saying all schools, canceled their spring semester. They still had school, but they sent kids home or sent them to their off-campus student housing where they would finish their coursework online. For the fall, most are saying, look, we're going to have probably less kids per classroom. Well, the same number of classes, we'll just split those classes up into maybe a Monday and Wednesday. To get back on campus, you're probably going to end up at most schools having to take a test to make sure you don't have it coming on campus. And then it's likely that you're going to be tested throughout the year. And then you're going to, in some schools, you're going to have a situation where just to get into the classroom, you're going to have to do one of those temporal temperature
things. Yeah.
So I think that that's really going to be the big difference. And what's going to be very interesting, and you're seeing more of this right now in the news. For those who are really paying attention to the asset class, the colleges and universities have to take this very seriously, because in a lot of cases they're taking kids, you're taking kids away from their parents, and the parents really trust the school to make sure that they get the kids home at the end of the year. And so some are announcing that they're going to limit the number of children that are in the dorms. So where the dorms, remember, you're talking about real estate constrained markets on campus. And so they really rely on putting 2, 3, 4 kids in a behind a key. And so they're saying that they're going to rely on master leases with off-campus providers as they decrease the headcount inside their dorms to make sure that they've got their social distancing inside the dorm rooms. So those are some of the steps.
This is actually going to increase the demand for the student housing off campus as the colleges, reduce the amount of student housing on campus.
We think that's going to be a story. It's too early to tell how much that's going to take place. And certainly every school is different. And then you have your blue states and your red states, and everybody's kind of handling it a little differently. But we think that it's just going to be very disparate. Where you go, each school is going to be different.
It brings to mind years ago, and I guess you're a little bit younger than I am by about a year. I'm kidding. Years ago when I went to school, we had triple session. We would have session, you go to school at 7 in the morning, and at 11:30 you were out of school, and new group came in. And then at 4 o'clock in the afternoon, a new group came in. It was called the baby boomers. And we had triple session at that time. And I think it's different now, where the triple session, so to speak, or split sessions, is just to keep the activity on campus and the congestion at a low level until we get a handle on this. So how is it affecting the housing now? If somebody paid for student housing, let's say, for this year, they're committed to the whole year, and how does it look as far as an advancement for getting housing next year? You can't wait till the last minute to get housing. So is the demand still as strong for student housing, let's say, this coming year as it was the previous year?
Well, there's the $1 million question, and that is developing on a daily basis. So I can tell you from an industry perspective, there's been a couple interesting things that we've been noticing. As an industry, we've noticed delinquencies lower. In other words, folks who had leases are staying. They may not be in the property proper. They may have gone home, or they may have gone off to spring break, or whatever the case may have been, but they continued to pay. Across the industry, delinquency is only in the high single digits, which was very surprising. Most had expected delinquency to go in the 50% range. Everybody's going to leave campus and stop paying. They're going to conserve cash. That has not necessarily taken place. I don't know if that's the kid's decision or the parents' call, but I'll tell you one of the things that's interesting. I think that one of the things we've seen, you're in Florida, right?
I'm in Wellington, Florida. Yes.
So 7 weeks ago, 8 weeks ago, when spring break was the big thing in the news, you guys down there had beaches full of college kids who were doing all the usual college kids spring break stuff, and everybody was scratching their heads. And it's funny, I'm out in California, and yesterday I was at the grocery, and there you had it. The folks our age, yours and my age, since we're so close in age, had our masks on, and the kids walking around of the 18, 19-year-old kids, none of them had their masks on. So
It can't happen to me type of thing. It's unfortunate. And we just have to get a control on it. I think that some people just like getting the flu. There are some people who get the flu, and some people who don't get the flu. And the days of having somebody come into your office where they're sniffling is gone. If you're sick, you're sniffling, you're coughing, get out of here. You're not playing cards with that person anymore. You're not hanging out with that person, be it the flu, the coronavirus, or whatever it is. So I think that people have to look and make sure they don't get locked out of housing next year when hopefully the colleges do open.
Right. Let me circle back and finish that answer, because I didn't quite, I hit the delinquency part, but I didn't get to what you really asked, which was what is the industry seeing in terms of leasing for next year? The industry is seeing very heavy renewals. So where kids would have gone out and looked for a different place, maybe a shinier, newer place, they're just renewing at the spot they were in. And as universities announce they're going to open for the fall semester, you're seeing very strong pre-leasing for the fall semester. So I think pre-leasing looks good. It still isn't as good as it was maybe last year at this time, but it isn't off by anywhere near as much as the industry participants thought it might be.
What is the occupancy rate? Well, let's say we're talking about a person who would like to put this in their portfolio as an alternative investment. What does an occupancy rate look like? A normal situation, not a virus situation, but a normal situation, what's the occupancy rate average?
Nationwide, it's north of 95%.
Okay. All right. I wanted
look,
to
look, and this is really what's really important there is that kids today have a very different idea about what constitutes an acceptable living environment than I'm 50. What I looked at when I was attending university, and these days, the one thing that hasn't changed is you got to be close to campus. Kids these days still want to roll out of bed 10 minutes before class, walk to class, get some Starbucks on the way or whatever the case may be. But this is where your operators really separate themselves. You got to have a sustainable competitive advantage. Typically that involves being close to campus. And then secondarily is really knowing that market and making sure that your ownership is with an operator who knows the dynamics of that market.
I guess I want to look at it for a second from the investment idea of somebody going into this class and they're now not getting an income, or their income is greatly reduced depending on the specific company that you're involved with and that. If an investor loses the income on this investment, there's no way to recapture that next year. I mean, is that income gone forever for the investor, or does the investor make that income that he loses because of this situation? Does he make it up?
Sure. It really depends on the investment vehicle, but typically it's not lost forever. So what's happening to a lot of operators these days is they're still getting the income. So we talked about delinquency rates being rather low, pre-leasing being strong, but you still have cutting distributions. Some all the way to zero, some 50%, some 25%.
I just lost them.
Hang on one second.
I lost you. Go ahead. You're back, right?
Yeah, sorry.
Okay.
It really depends, but no, it's not lost. Typically, it'll accrue in the background, and at some point in the future, whether it's this fall or um, uh, early fall, say August, September, or later fall, maybe next spring, when things start to clear up. And it's not that it hasn't gone away. It's also that typically, if the income is reduced, you're going to see what's not being paid earn some sort of penalty interest as well.
Well, I guess now in the final question, we're getting near the end. If you do an investment in student housing, and you're getting an income per year, is the idea that you're in it just to get the income and you sell the building, or is there potential for the investor to get something besides their annual dividend?
Yeah, that's a great question. So that's really probably, when you look at the many reasons to look at the asset class, that's probably the primary reason to look at it. And that you talked about in the beginning about talk about the asset class historically. And the biggest change over the course of the last 10 years is that you've seen a lot of income interested parties. We're talking about sovereign funds, foundations, and endowments that have to meet pension obligations, that invest for just that cash flow component, entering into this space. Because over the course of the last 10 years, you've had a little bit of this with your traditional multifamily cash flow, but the trend has been down. And so where do they go to get cash flow? Certainly interest rates have been historically low. And so where do you go? Well, you go to an asset class that looks just like what they're very accustomed to investing in, which is market rate multifamily, which is where historically they've gone to get that yield. And so as they go and look at the next highest income producing asset class that looks familiar to them, that's student housing, because the properties look very similar. They just needed to get their hands around the risk profile. Is this Animal House? Are we going to have properties that are going to have holes in walls and things like that? And they've learned that that's not the case. The dynamics have changed. There's now parental guarantees, 12-month leases, things of that nature that protect the assets so that you don't have that Animal House effect that people typically associate with the asset class. And as they've entered the space, as the big smart money's entered the space, it's provided opportunities for your smaller operators who have been in the asset class prior to those guys coming in to earn some real potential on the back end as well. So the investors at the smaller operators have good income, and then as folks come in and bid up the asset class, a nice potential for capital appreciation on the back end as well. That's been a hallmark of the asset class.
I think I skipped over in the middle the investment itself. In other words, when somebody comes in and does an investment and the company is accumulating these assets, what are they doing with the assets? Are they renovating? Are they leaving built apartments empty? What are they doing with the funds coming in to increase the value of the asset?
That's a great question. So it really depends. It's similar to really any other real estate asset class. There's different tranches of it. So you've got people who develop the asset class, who are raising money to go build something. You have operators who are buying Class B, Class C properties, who are going in and dumping a lot of money into the property to improve it, where you can see it's a riskier appetite type product. And then you're having your just straight cash flow type properties where you buy it, you reserve a little bit just for ongoing paint and refreshing the property on an annual basis. And so it really depends.
Cosmetics, what?
Right.
Okay. Overall, how do you see the asset class in the next 2, 3, 5 years? I think you've more or less done it, but I'd like to sum it up and what your feeling is and how you feel that this would be a good asset class.
Well, look, the lot has changed over the course of the last 7 weeks, but a lot also hasn't changed. University enrollment going into this was strong. We had a 25-year 25-year upward trend nationally. Now you get in various sub-markets, you get, ups and downs, but nationally you'd see enrollment growth going into this current pandemic. The trend was sort of flatline for about the next 3 to 4 years, with now growing again for the next 10 to 15 years enrollment nationally. We think those things are going to continue unabated. I think that if we do enter a recession, the value of a college education is going to be highlighted once again. And we feel very optimistic about it at our firm. And to be honest with you, there's more people than ever looking at the asset class today. So I feel like it's bright, but as competition grows, it's going to be more important than ever to make sure that you're implementing solid due diligence fundamentals.
I just want everybody to understand, we're trying to educate on different classes. When you have a financial portfolio, a lot of people are with one particular broker, and that broker has not an objective, but they deal in one thing. When you're building a house, the best part of a house, or the strongest part of the house, is a foundation. And with a strong foundation, you build up. The person that puts the foundation of a house down is not the same person that puts the walls and siding of your house up. It's not the same person that puts electricity in and wires your house. It's not the same person that puts a roof in. There shouldn't be any one particular financial advisor that does everything for you. And that's why the podcast is dedicated to alternative choices. And that's the name of my podcast. It's Investment Choices Other Than Stocks, Bonds, and Mutual Funds. I want to thank Jason. Jason, you were super. I love the class. I think there's the asset class. I think there's a definite need or can fit in somebody's portfolio. And again, this is for not every person. You need to be a qualified investor, and you shouldn't look into this without getting the advice of your financial consultant or financial advisor. You can contact them or me, whichever you'd like. This is Mike Ecker, Investment Choices Other Than Stocks, Bonds, and Mutual Funds. Thanks a lot. Everybody stay safe, and let everybody know about the podcast so they can see what we're doing here. Jason, again, thank you very much. Stay safe, my friend.
Thank you. You too.
Thank you for listening. Remember, things just don't happen when it comes to your financial future. This is Mike Ecker, and you've been listening to Investment Choices.